Hello traders, Gary Wagner here. It is approximately 11 a.m. in Honolulu, 5 o'clock in New York City. It's Friday, the end of the week finally, 20th day of January 2012, and this is the daily report for gold and silver, our weekend review. Very nice, strong showing for the last day of the week in the precious metals. We have both gold and silver up with nice solid gains, but the very, very interesting gain that we have is an utter breakout in the silver market. We'll get to that in a little bit. I do want to start with the gold market. We're going to look at it in a couple of different ways, daily and weekly, Henkin and candlestick. So let's start with our weekly so we can get a solid feel for what we saw overall. We're looking at weekly Henkin candles. Now, with the Henkin candle, unlike a standard candlestick, Japanese candlestick, what they are doing is they're taking the data from yesterday and comparing that to the data today. So if the market's trading above certain parameters, it's going to stay green even if it's a down day. For the last 2 weeks, we have had solid gains. You can see the basic things that I look for. Absence of lower wick. We've got it here. We've also got it here. Now that's coming after the market had sold off. 1802 up here. Comes down, tests this low right around, I believe, around 1520. And then we had this consolidating doji, the small body doji here that you get. And then the last 2 weeks have absolutely been runaway, and they have been strong. Now, here is a differentiation that you're going to find once you go into the candlesticks, because whereas we saw that doji-like candle, that was at pivotal point, take a look at that same candle right in here in straight candlestick format, and I'm speaking about in particular this one here. That was our doji candle, but here you've got that engulfing bullish, very, very nice reversal signal. Of course, traders following my daily service, we got in roughly at this area, 1580. And again, this is our weekly chart, and this is not to scale. I can't see where it is, but roughly in this area. And we have been riding on the shirt tails. We've got almost $90 now on the trade. Aggressive traders actually went in and bought midweek, added to that position a little bit, about $10 below this. So we'll have to see what the market wants to do. What do I think we're looking at, and where do I think this market's going to? To do something like that, we really want to start looking at our daily, because what I'm noticing in the marketplace itself is that we are getting really a series of sharp rallies. The market trades sideways or consolidates, then another breakout sharp rally, we get that consolidation, and then another breakout. So you're getting a series of moves within the market where, unlike when it is range trading, when it's in a full Super Bowl rally, and we know what that looks like because we've seen it many, many times before. We just haven't seen it in a while as this market consolidated after the correction. But when you get these sustained rallies like this, you do not tend to get retracements. What you do get are these periods of consolidation in the market, then a spike up, consolidation in the market, then a spike up, consolidates for a little while, meaning it trades sideways and then moves up. So what are we looking at for here? For those of you who read my Kitco article, Running of the Bulls, Part 1, 2012, what I talk about is the fact that we literally use Wave 1 as our absolute benchmark, and once we have a fix on Wave 1, we use that for a lot of analysis. We're looking for, on standard, about a 61% retracement. You get a deep retracement into 2. 3 is going to be at least the same size, if not bigger, but call it 1.23 or 1.38 times that of 1. Then you get a smaller correction, usually 38%, and then you get your final fifth wave. So until we really have a fix on what Wave 1 is in terms of how steep its climb was and the price move or the change, we really don't have a lot in terms of frontward forecasting this entire what we call an impulse phase. Now, in an impulse phase, of course, what you're looking at is, in essence, the entire cycle. What we call an impulse cycle is composed of 8 waves. You've got wave 1, 2, 3, 4, and then 5. That completes the impulse cycle. And then you go into the corrective part, or the corrective waves of the impulse cycle, which is A, B, and then your final C, and then of course that repeats again. So when we look at the big picture here, we've gotten, this was one's concluding, then we've got our corrective, we've got our third, we have this triangle or long, what I call a protracted corrective wave, and then this tremendous spike up. This would be the top, and this is actually 5, and it's also called the orthodox top because B was actually above that. Then we get, when we look at the bigger picture, we go from our A, and that would go all the way down here, bigger picture B, and then C. Of course, what you're seeing, or what I've got on the screen, are the subwave counts found within it, so that within this A, B, and C, we had a 3 count, 1, 2, 3. We had a 3 count, 1, 2, 3, and then a 5 count, 1, 2, 3, 4, 5. The interesting thing that I pointed out is, for those of you who recall the December 16th article I wrote at Kitco, the market was trading right in this area, and it was my belief at that time, this was on December the 16th, was my belief at this time that we would probably get that count, which was a count of 3, 3, 5. And we got this right. We got the 3 right. We also got the 3 right here. And we were at 3 again. And I said, well, we're probably going to see a 4 and then a 5. And I also said that we're probably going to get a flat. And the reason that I was looking for a flat was my underlying bullish bias, and seeing this market correct from 1900 to an intraday low below 1600, that tremendous move down, giving up about 61%. If we do a retracement from the beginning of July up to here, you've got a tremendous retracement. And even if you do it from the beginning of this entire move, which is what this is, in other words, we're running a long-term Fibonacci retracement from the beginning of the impulse cycle right here, 1307, taking it all the way up to this record top, 1920. And when it corrects, take a look at this. The correction comes to a 61% retracement of this large move. That to me seemed more than adequate, absolutely, and thereby I saw that as my call. Now, the big story, of course, especially today, more than ever, is the silver market. Absolute, utter, strong breakout, trading currently $32. And realize, traders, we're in at 28.10. We've got roughly a $4 trade in silver on our hands. Look at a 5,000-ounce contract. You're talking about a $20,000 gain on a contract of silver that takes, I believe, under 30,000 to control. Incredibly good profits. Let's take a look from 2 vantage points, weekly and daily. Let's also take a look at Fibonacci as well as straightforward candlesticks, because they both reveal distinct and different information. So let's start with our weeklies, and that gives us a pretty big picture. Like the gold, what you notice on these Henkin candles, and once we convert it back into a daily, you'll see what I mean. Even though we're trading up near the highs, because it's using a comparison from yesterday, you are not getting that full body that covers the entire range of the day. It's a Henkin candle. It's lagging. It lags in both ways. However, you do get this absence of tail, and you also get a very, very nice size body, a body that's significant of a market that could really be beginning to take off. When you look at this rally that we had back in February, you get that small doji that begins everything. All right, that's your pivot or your reversal right there. And here we got 2 of them. We got a green one here, and we had this particular doji, 2 pivot points telling us the market's turning around. The following week, you get a nice candle. It still has a sizable upper wick, but you notice these all have sizable upper wicks all the way through this rally. But what you are noticing is, aside from small points of consolidation where it gains its wick, this of course again is a weekly, look at the, as it went to new highs, look at how these candle sizes grow. This trend is just exploding until it reaches the apex, that top, and at that point, boom, you get your reversal. Are we seeing something similar again? Well, it is a little bit too early to tell, but I can tell you this. For this particular type of explosive rally to begin, it starts in the same way that that rally began, and it matches very nicely with what we're seeing so far. It doesn't mean that we're going to see a follow-through, but if this rally was to be explosive like this February rally, in other words, it's that next year, it's time again for these markets to run. That's what I talk about in running of the bulls, that we do have this. It's not seasonal, it's more matter of cycles itself, but we're back into that bullish mode and bullish cycle. Interesting, when we go ahead and convert this back into our standard candlestick and we just remove this technical study, you get a different sort of a picture, because like gold, you get these 3 candles. But what's very significant, of course, in my opinion here, is the fact that you have what's called almost a Marubozu long white candle. There is a what's called a bazu and a Marubozu. It simply means shaven head in Japanese. What it's referring to is these lack of wicks here. And that's significant because, look, the market is opening near the low of the day. It never really makes too much of a lower low. Closes near the high. Marubozu is the strongest of all types of candles, both red and green. And you can see the significance of when you get these Marubozus. You tend to get them as the market's just rallying up. You've got one here. You've got one here. You've got one right here. And these are very, very significant candles because it's opening near the low, closing near the high. Weekly candle, impeccably strong. Very, very nice rally. Now, we want to take a look at our daily chart. And when we do that, here's what you're going to find that's pretty significant. Again, when we take a look at this market, it can be best categorized as it's moving up as a nice rally to the upside, a point in time where the market kind of trades sideways, it consolidates, then it breaks back to the upside, and it takes a rest. It consolidates. You are not getting, and then of course you get the continuation of the rally. What is that telling us? The difference is when the market is either range bound or correcting and running through different support and resistance levels, it will tend to track those levels. So it will go up, it'll hit resistance, go back down, test support, and you get this kind of saw pattern, and that's indicative of a market that is rallying, but you're getting these strong corrections, and it really isn't the utter breakouts. When you get a market that is just in straight rally mode, you don't really get any kind of sharp corrections. You basically get the market trading sideways for a while. Now, I'm going to go ahead and convert this, as we did with the other one, back into our daily chart so we can talk about the different resistance points that I was looking at. Remember, we're in at 2810, and our original target that we had was 3182, and that is really where I believed we would see this market run into some kind of resistance. And let me show you where I got that number from, but I can tell you this, as of right now, it's closing above it. Very, very strong signal. This, of course, daily chart, straight candlestick format, and here's what you're seeing. We're taking our Fibonacci retracement, beginning of February, to the record top. Prices are off just a little bit in terms of where I've put the top and bottom. Let me go ahead and straighten that out. So you can see how we've adjusted 3191, and that's where I got my number 3186 from this same point. But here's what's interesting. Take a look at really what's happened in this market over the year and last year. February, we get this incredible surge, runs to a new record high. Of course, it reached it 20 years ago when the Hunts tried to take over the silver market. We haven't seen it in decades. So to me, it's a new record, at least for a lot of people trading. The market comes down, and look at where it goes. It actually doesn't find any kind of support until it's retraced 76% of that move. And that's where we saw silver lose, what, 26% in value in a period of a couple of weeks. So the market then comes up and it tests this 50%, 3807, can't hold it. It comes back down. It doesn't quite go to the 76% level. It finds support right in this area, but after that it attempts to strategically move back to the highs. It comes back and it runs into resistance. This is that 38% at $40, trades back down. It makes a second attempt to do it, makes a new high and a higher low, but then it makes a lower low here, makes a higher high here, but it stalls where? Well, right at that 23%. That was an area that the market just couldn't take out. So once we got into that scenario, we really just started testing and breaking through until it did what? it made its second test of this low. Test number 1 here. This is that low right in here. It tested for the first time. As it trades back up, it finds first it tests this 76% area, breaks above it, stalls at the 61% level. This is $35, but it couldn't hold any levels whatsoever. So it methodically, from November all the way through near to the beginning or end of the calendar year 2011, it goes for its third low right in here. It's second testing after hitting this low. And what I'm finding interesting is that following that, it was such a solid move that it not only traded, but it is trading now just at or above that resistance. So what are we going to see? Well, our next target, our next strong target is got to be $35 an ounce. Why? Because we don't really get significant or what I'll call hard resistance until that. We do have some soft resistance. Soft resistance is going to be right around the highs here, so it's just below $34, but we'll have to see how it reacts. Great trading week. We have good positions on Monday and Tuesday. We'll talk about the targets that we have, points that we want to look at in between these very hard resistance targets. This has been Gary Wagner, wishing you as always good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.